Well, the Westpac Melbourne Institute Consumer Sentiment Index fell by 3% in July. The survey was taken in the week of the Reserve Bank rate hike over the Monday, Tuesday, Wednesday, Thursday. RBA hiked rates on the Tuesday earlier in the month of July. Down to 83.8. That is a comparable low level with other periods of major dislocation in the economy, global financial crisis, the recession in the early 1990s, the slowdown in the mid-80s and the recession in the early 80s. And the pace of fall of the index is also comparable now. So basically the index has been falling every month since December of last year. It's down by 19.7%, and that compares with the 6 months falls that we saw in those other periods of around about that 20-25% fall. So we are seeing quite a number of quite eerie comparisons with those periods of major dislocation. As we reported last month, 60% of respondents in last month's survey nominated inflation as the most important news item that they'd seen, and that compared to a normal 12%. But we only saw 24% nominating interest rates, and I thought that was a little low. I thought more people would be aware of those interest rate hikes. A way of comparing that was that last month we looked at the survey results before the Reserve Bank announcement of the 50 basis point hike in June and after, and the index was about 2% lower after than it was before. With the 50 basis point hike that we've seen in July, the index fell by nearly 8% after relative to before. So what that's telling me is that interest rates are becoming more and more of an impact upon confidence as they get higher. And another way of looking at that is that last month, 65% of respondents thought that rates would go up by more than 1% over the next 12 months. That's now up to 73%, and bearing in mind that rates are another 0.5% higher than they were last month. So clearly a lot more awareness of the higher rates and a lot more sensitivity as those rates really do start to impact upon consumers. Still very strong confidence around the labour market. The labour market index is around 110, long run average is 130. The lower the index, the more confident people are that the unemployment rate's not going to rise. But what we saw, say, in the global financial crisis is that the low point in confidence was about 6 months before the labour market indicator really started to deteriorate. So while we can see low points in confidence now, that doesn't necessarily mean that the labour market is not going to deteriorate further down the track. And of course we are expecting that through the course of 2023, when growth slows from the 4% we're expecting this year down to 2%, that we will start to see some deterioration in the labour market. The other big story, of course, is around the housing market, and our house price expectations index fell another 5.6%. It is now around that 105 level, so there's still more people expecting house prices to rise than fall, but that's a national number, and the smaller states we have a lot more relative optimists than we have in New South Wales and Victoria. In New South Wales that index is now at 97, so it's below the 100 level, and in Victoria it's at 99. But bear in mind that that index can fall a lot further. Back in 17-18, when house prices were falling in Sydney and Melbourne, those indexes got down to around the 70 level. So I think there's a long way to go in terms of confidence around the housing market as we move further into this tightening cycle. It was interesting also that we saw the NAB survey for business confidence yesterday, and that index showed quite a tumble in business confidence as well. And that survey was taken before the July rate hike. So we're now starting to see the coincidence of falling consumer confidence and business confidence now starting to take a tumble. So what does all that mean for interest rates? Well, the Reserve Bank meets again on August the 2nd, and my view is that they need to raise rates again by 50 basis points. That'll be the third month in a row that they will have done 50 basis points, because we are going to see the next inflation report on the 27th of July. And I think that'll show that underlying inflation, which is the one that the Reserve Bank follows mostly for their policy, will have lifted from 3.7% to 4.5%. That's a big number, bearing in mind they want to see inflation between 2 and 3%, and headline inflation from 5.1 up to 5.8. So I think that'll be a big enough number for the Reserve Bank to see the need to do another 50 basis point hike. Because bear in mind the starting point at the moment, 1.35%, is still below the neutral range between 1.5 and 2 is where we assess neutral. So if they go 50 in August, that'll put rates up to 1.85% at the upper range of neutral, and I think that will be the time to pause. So it's my view that in September and October, the Reserve Bank can pause, can take notice of what we're seeing on these confidence numbers, can assess what's happening in the housing market, and because they have so many more meetings than other central banks, RBA has 11 a year, the Federal Reserve only has 8, New Zealand only has 7, they can afford to take a pause during the cycle, and we've seen that in previous rate hike cycles. Even in '94, when they did 275 basis points, they took pauses through that tightening cycle. So I would like to see a pause in September and October, but once again in November we'll see another big inflation report, and I think they'll have to respond to that. And we would expect a 25 in November, 25 in December, and then another one in February in response to yet another big inflation report in the December quarter. So where is our thinking now relative to markets? It's been a big, long-running story that the economists have had a lower profile than the markets, and certainly we've been in that category. But the markets were at one point were saying that rates were going to get up to 4.5%, and those hikes would go through 2023. Now we've seen some big reassessment by the markets. The markets now have a peak of around 3.5% in the first half of 2023. And the difference between Westpac and the markets now is that we have a peak of 2.6%, whereas the markets have 3.5%. And all of that difference is in that last few months of this year. We're expecting a hike in February. Markets are close to expecting one last hike. But they're expecting rates to be up around 3.25% by the end of the year compared to our 2.35%. Where's the difference? The markets are saying in those last 4 months we'll see probably 250 basis point hikes and 225s, whereas we're only looking for 225. So that's where the difference is now. It's nowhere near as far away as we had been in the past, and it's the markets that's come to our forecasts rather than us going to the market's forecast. So it'll be a big deal as to whether the Reserve Bank decides to pause. I think that'll be the best policy, but of course we will get a fair idea as to whether they're thinking about that when we see the governor's statement following the decision to raise rates in August, and I think that will be a 50 basis point hike. Thank you very much.